I spent weeks analyzing the 34 Qrops approved funds on HMRC, whether it's Kotak or ICICI or HDFC. I analyzed the 34 funds, and here is my honest conclusion. Other than potentially saving some money on inheritance tax, there is really no need to transfer your UK pension abroad using Qrops, and I'll show you what to do instead. Before we start, this is for DC pension, or like a private pension or a SIP that you personally invest into. It is not a defined benefit pension like the NHS or the teacher's pension, etc. I've done a video on the NHS pension, what to do if you're transferring abroad, but this is specifically for DC pensions or private pensions and what to do about it when you leave UK. Here are the costs associated to transferring via the Qrops. There's a 25% lump sum trap. 25% of your pension pot is taxed at source. You can claim this back if you're still living in India after 5 years. But if you move countries or if sometimes you even forget to claim this back, or the admin burden involved, 25% is just gone just like that. And that is a big amount of money when it's something like a pension where you accrue large sums of money. Next is there's an overseas transfer allowance. So if your pension pot exceeds the old lifetime allowance of over 1 million, 1.73 million to be exact, then your pension pot over this amount is taxed at 25% as well. The next is exit fees. Most UK platforms charges about £500 for the admin involved to transfer the pension abroad. Next is the destination setup cost. The setup cost for this can vary between 1 and 3%. And on top of that, most of you will have an agent fees. If you post on any WhatsApp groups or Facebook groups about Qrops, there'll be loads of agents saying that we can help you with this. So there's an agent's commission fee that is quite high with Qrops transfers. And on top of that, you cannot touch your pension pot for 10 years after you move out of the country. So say you leave the UK at 50, you cannot touch this pension pot till 60. Whereas if you were in the UK, you could have accessed this around 56, 57 years of age. So that is the costs involved for the Qrops transfer. While going through these 34 funds, another thing I noticed was each and every one of them is an annuity. In UK, nobody buys an annuity anymore. If you don't know what an annuity is, it's like a set income for life. So you give your pension pot and the bank values it and gives you a set income for life. In UK, nobody buys an annuity anymore because at the end of the day, it's mostly the banks who's better off buying an annuity compared to the individual who's giving up their pension pot. And all the 34 funds that I analyzed, everything is an annuity. Also looking at these Qrops approved funds in India, I noticed that each and every one has a life insurance element attached to it. So it's an investment element and a life insurance element. And I think it's common knowledge now that life insurance products and investment products should be kept separate, because if there's a life insurance attached to it, the returns are very poor. And each and every one of these 34 funds was an annuity as well as a life insurance element attached to it. Whereas if you just kept your funds in the UK, you can control the risk, you can control the withdrawals, you can control your tax status. This gives you full flexibility if you still keep your pension here in the UK. The main selling point of the Qrops is what they say is the tax advantages. I'll break that down. Qrops is often sold as tax-free growth, and if you've been using a UK pension already, you know it's tax-free growth within the UK pension. The next is income tax. People talk about this 55% tax charges that is avoided if you transfer via Qrops. I don't know where they've got this 55% number from. We all know that the maximum tax in the UK is 45%, but there's a lot of tax strategies that people use, and actually very common tax strategies that people use for DC pension, where they can control their withdrawals and keep under this 50,000 to keep under this 20% bracket. So to minimize the income tax at retirement. So I do not think avoiding income tax is a reason to transfer your pension abroad. Third advantage that they say to transfer via Qrops is to avoid inheritance tax. In the UK, there is a 40% inheritance tax if your assets exceeds over £500,000, or if you're married or in a civil partnership, if your assets exceed over £1 million. And even then, there is lots of things that you can do to manage your inheritance tax liability. I've done a whole PDF about how expats in the UK can manage inheritance tax and the different things that we need to be aware of. If you want a link to that, it will be in the description box below. But even if you were to pay inheritance tax, Martin Lewis, money saving expert, he says only 5% of estates pay inheritance tax. So it's a very small proportion of the people. So you probably watching this after you've done all the things that I've said in the PDF to manage your inheritance tax. You probably don't come under this inheritance tax threshold. It's for people who've got millions and millions of assets and things and generational wealth who need to think about inheritance tax. For people who are probably watching this, even if we have surplus of money that is over 1 million, we're unlikely to come under the inheritance tax threshold. If you were the 5% of the population who would fall under this inheritance tax bracket, only then transferring via Qrops is a serious option, because there is no inheritance tax to be paid in India. Whereas if you were in the UK, over certain thresholds, you pay inheritance tax. So to avoid inheritance tax is the only small reason to consider to transfer your pension abroad via Qrops. The costs and things to transfer via Qrops certainly adds up, whereas the other tax implications are not that heavy or easily managed. So here are the steps you can do instead of transferring your money abroad using Qrops. One is to keep a UK bank account open. It'll just make things easier in the future in case there is any problems to transfer your pension abroad. You can still receive it in a UK bank account. Next, before you leave, consolidate your pension. If you've got 4 or 5 different employers with 4 or 5 different pension pots, consolidate into a private SIP and keep it all nice and tidy. So you're not abroad and managing 4 or 5 different pensions and it's just one tidy pension. So consolidate your pensions if you're thinking of leaving the country. Next is to update your nominees. I recently heard a story of a person who had not updated his nominees, and he went on to marry and have another family, but because he had not updated his nominee, his pension went to his ex-spouse. So that can be easily avoided, and keep your nomination form updated. Nearly all mainstream pension providers has a facility of transferring their pension abroad. So just go into your platform's terms and conditions and familiarize yourself with the proceedings. But you can actually receive your pension abroad, even in a foreign bank account. You need to update your UK pension platform 4 to 6 months in advance to get the proceedings and the paperwork rolling. But you can actually receive it either to your UK bank account and then you can transfer it, or directly receive it to your foreign bank account abroad. Just a quick note that this is the opinion that I have come to after weeks of research and looking through all this paperwork, but you please continue doing your own research and speak to an accountant who's familiar with both UK and Indian Qrops and things. Or if you're a person watching this who's had a positive experience with Qrops, I'd love to hear about it. Please let me know in the comments below. If you're planning to move abroad, don't forget your state pension. That's something that you can receive abroad too. I've done a whole video about it. Please feel free to check it out. I'll see you in the next video. Bye.